too many of the retail traders are ignoring the facts that are right in front of their face. We do this, all the time in markets, and we look at them and we forget that there's a lot of trouble out there. Nobody's talking about that banks are borrowing at a record pace on the emergency lending rate from the Federal Reserve. This is the same thing that happened in 2008 before the big collapse. There's a lot of warning signs. Look at what's going on in the grain markets. The grain markets are getting hammered. Yet we talk about a CPI at 3% when true inflation is probably closer to 20% when you talk about food and energy. But of course, that's not included in there.
Let's talk about trading with Todd Bubba Horwitz. He is a chief market strategist at BubbaTrading.com. We'll be talking about the markets, the specific asset classes he likes and dislikes, how he's trading the markets right now, and a guide to options trading, which we'll be discussing towards the end of the interview. So stay tuned to the end. Thank you, Bubba, for joining us again. Good to see you as always.
David, it's always great to be on the Lynn Report. It's always been a pleasure to do business with you.
Thanks very much. It's been a wild summer. Stocks have been down quite a bit from their highs. Had a bit of a rebound earlier in the month in September, late August, and now it's kind of just trailing sideways. Let's talk about the S&P 500 first. What do you make of this action? Have we seen the top already for the year?
I think the tops are in. I think that we're in for a pretty healthy sell-off into the fourth quarter. Again, I'm not going to fight it right now. I am short personally the S&P futures. I think you're in a consolidation range, which if you're a trader, that's the most frustrating pattern there is. There's three basic patterns in the market, consolidation being the worst, which actually where the market spends the most amount of time. The bulls and the bears keep fighting to break the market one way or the other. And right now, nobody's winning, but it looks to me that the bears are going to take control here, especially with a lot of the data coming out this week.
Okay, let's talk about that. Why do you think the bears are going to take control? Are you looking at volume? Are you looking at put-call ratio? What indicators are you looking at?
I'm looking at the volume. I'm looking at the overall price action. I'm looking who the participants are. And I think that, unfortunately, too many of the retail traders are ignoring the facts that are right in front of their face. We do this, all the time in markets, and we look at them and we forget that there's a lot of trouble out there. Nobody's talking about that banks are borrowing at a record pace on the emergency lending rate from the Federal Reserve. This is the same thing that happened in 2008 before the big collapse. There's a lot of warning signs. Look at what's going on in the grain markets. The grain markets are getting hammered. Yet we talk about a CPI at 3% when true inflation is probably closer to 20% when you talk about food and energy. But of course, that's not included in there. So you have a lot of reasons that markets are going to have some trouble. And now you talk about jobs, which, again, we keep getting these good jobs reports. But the true story behind the jobs is we've lost 514,000 jobs this year, but nobody ever pays attention. Look at the revisions of jobs.
Yeah, that's a good point. Jobs were revised, new jobs added were revised downwards earlier this year. Okay, you brought up inflation, a lot of key data coming out this week. So it's true, actually, if you break down the CPI, Bubba, you can see that food inflation is up double digits. So the overall index is down. Maybe because of energy. Energy was down early in the year. Now it's spiked up. Let's talk about oil first before we talk about overall inflation. So, like I said, oil's been sideways all year until it spiked up recently. What's going on there? Are you trading oil?
Oh, yeah. I'm long oil and have been long oil since the 60s. As we talked about last time I was on with you, Saudi Arabia is going to continue to cut production until they get the prices where they want them to be. And considering that the United States is at lows had not seen since 1985 of inventory. Okay, Saudi Arabia holds all the cards here. You have an administration that wants to give every bit of power away, and we're at the mercy of the OPEC and Saudi Arabia as far as oil. And I would suspect that oil will be over $100 before the year is over.
Over $100. Can you again break down why it's been rallying from mid-July? It would drop to around $67 and $69 all the way up to $88 now. It's been a huge run. Can you break down what happened here?
Yeah, sure. OPEC cut production. So they squeeze the market, they shorten the supply. So if you look at your old economics class and supply demand curve, there's a bigger demand than there is a supply. And of course, if demand slows, which it probably will with a weakening economy, then Saudi Arabia will cut production once again and force the prices back up again, forcing Americans and everybody else around the world to pay more for their costs at the pump. And of course, the one thing that nobody else talks about is that the tax in the United States, the federal tax it's on gasoline, it may only be, let's say it's 5%, but if you're at 5% of $2 versus 5% of $5, it's quite a big hit to the average payroll and the average person who's taking money out of their pocket to pay for that. Where are they going to get the money when you're not making enough money to pay for anything as it begins with, not to mention jobs are weakening?
What do you think is going to happen with the Strategic Petroleum Reserve in the U.S.? Do you think the administration is going to release more and maybe help with the gas pump prices?
I don't think they can release anymore. They're already at record lows. I mean, that oil is meant for wartime. That is not meant to be to worry about elections and worry about prices. Okay, so you've got a big problem, and now how are you going to refill that when you're going to have to pay a dramatic amount from Saudi Arabia to refill your wartime oil and your strategic reserve that is there for in case of emergency? Our drillers here, the frackers and shale producers, can't suddenly decide to ramp up production and produce it right away. It's going to take a big project to get them to be able to do so. And, this is the problem when you have an administration trying to break America and destroy all small business. This is how you do it.
Actually, as of August, I was reading this article from PBS. The Biden administration is delaying plans to restock the nation's emergency oil reserve amid a price hike that has pushed oil above $80 a barrel. The Energy Department canceled a planned purchase of 6 million barrels for the strategic reserve this week, saying it wants to secure a good deal for taxpayers. So even the government thinks the oil price is high. Todd,
well, they don't care. But they're the ones who forced it up there. That's the point. See, they don't care that oil is higher. They want it higher because they want to destroy all small business. They want the conglomerates to control the world. It's very simple, David. We have enough oil in this country. We have a 300-year supply at current usage right now without digging into the environment, without changing the climate, the carbon footprint in this country. But they decided not to do that because, of course, there's money involved when you're getting payoffs from OPEC and you're getting payoffs from other places. Why should you drill your own oil? Take the payoff from somebody else.
Yeah. Okay. Well, so I suppose you're long oil then right now. You're waiting for $100 and then you're taking some off the table.
We'll see. I think I got a feeling that next year you might see all-time new highs in oil. You might see 150 plus.
How's this going to impact the overall CPI index, inflation?
Well, again, when you don't have an accurate number and they don't report accurately, it's hard to say because food and energy only account for 4% of the entire index. Okay, so I'll tell you what, the CPI will probably come out at, let's say, 3% or 2.9. They'll say, oh, we're doing a great job with inflation, but they don't count enough. The number one and two costs for the average American in this country is food and energy, barring a major expense like a refrigerator or whatever. They're counting computers and refrigerators in their tally, which how often you replace a refrigerator? Every 10 years? They're not counting the things that you need to use each and every day.
The personal consumption, the core PCE expenditures, which is the preferred measure by the Federal Reserve, that's still above 4.2%. That strips out food and energy. Why do you think even X energy and X food, the inflation index has been pretty high, especially from the services sector? Well,
because everything is costing more. Look at what it costs to hire people. Look at what it costs. You realize that most companies are paying double what minimum wages, and it's not enough. People can't live on that. The cost of living has gone way up, and the Fed continues to fight with their ridiculous thoughts of a 2%, which they can't get to. And look at interest rates. Just a year ago, interest rates were 3%. Now the 10 years almost 5%, and probably on its way to 6%. So what about mortgages? How about rents? Everything else is going up astronomically because expenses are going up. So the landlords and the providers have to raise their prices just to keep up with the pace. Forget about trying to make any real money. And of course, commodities are getting hammered, but yet the prices keep going up at the store. So the producers aren't making any money. They're actually losing money, but the retailer is selling it. The divergence between wholesale and retail, or the producer and the actual selling, has never been this wide.
So what you're saying is we should all go to Costco and we should buy Costco stocks.
We should go to Costco and still we're paying way too much, even at Costco, because certainly all of our goods and services would be a lot cheaper if we would have continued producing our own oil and being a net exporter of oil, because we'd be paying $2 a gallon instead of $5.
A lot of just on that note, a lot of the price of the gas pump is taxes. Why does it, just tell us this, why does the government need to charge a huge amount in taxes for gas when it's, basically a necessity for most people? Where does that money go?
It goes into their coffers. It goes into their campaigns. It goes into wherever they want it to go into. Remember, if you and I lived like government was run, okay, we'd be either in bankruptcy court or jail. We don't get the opportunity to go over budget. They don't keep any budget. It doesn't matter. So you look around the country and look at the highest tax states in the United States, California, New York, and Illinois, and they're always broke and they're charging ridiculous amounts of taxes, whereas Florida and Texas are flush with cash and they don't charge taxes.
Let's look ahead this week. A lot of data. CPI is coming out Wednesday. We're speaking today on Tuesday. What's your expectation? Last time we had a reading of 3.2%. Is it going to be around? I mean, nobody knows. We're all just speculating a day ahead. But just based on what you've observed, is it going to be? Are we going to see any significant changes? You think?
I think it'll probably come in better than expected. Okay, only because again, the numbers never lie, but the people report them do. And the way that they can report, there's a lot of things you can do to report, and you can revise them later. Nobody pays attention. So I'm going to assume that it won't be worse. It'll be at least the same, if not better than expected, so that President Biden can go on TV and on his commercial and tell you how good he's done for the economy. Okay. So I don't think that it's going to be a disastrous miss. I think the big number this week will also be PPI, which is on Thursday.
So yeah, let's. This week we've got CPI, PPI on Thursday. Initial jobless claims come out on Thursday as well. Retail sales come out Thursday, and then Friday we've got industrial production and manufacturing survey. Which of these data points are for you as a trader most important?
I mean, for me, none of these numbers are really important from actually looking at them because I know they're false. Okay. I will say this, that the only numbers that I really ever care about are ISM, because those are private numbers. Okay. The manufacturing and the services number. But out of the government numbers, the ones that should make this markets react the biggest will be CPI and PPI this week. These are two of the bigger numbers, especially in the condition that the country is in right now, with massive inflation that we're not admitting to. And of course, a huge amount of senior citizens that their Social Security checks cannot possibly keep up with the pace of inflation.
So you think that maybe the Federal Reserve may change their outlook by the end of the year if inflation continues to run hot? Do you think they'll stay hawkish? Maybe
I think they're hawkish until the 10 years get to 6%. That's my prediction. I think that, listen, the Fed lost control. They made a mistake in the first part. You can go back to 2013 when Ben Bernanke in May of 2013 panicked when the market started to sell off when he wanted to hike rates then. They stayed too low for too long. They let the banks get over leveraged. And I don't care what the stress test says when they come out and give you the stress test. And they, the banks are in great shape. You know right away that's a problem. Okay. The banks are in trouble. They're over leveraged. We've already seen a couple of the regional banks go under, and they're trying to guard off of this. But the emergency lending rate tells you that the banks are over leveraged and they have problems. And now you're talking about a potential another COVID shutdown. What do you think is going to happen then?
Are you surprised that the 30-year mortgage rate has been coming down slightly? It's been kind of trickling down ever since mid-August, but we're not yet seeing a surge in transactions, either buying or selling of homes. Maybe it'll take some time.
I haven't seen them come down, David. I mean, maybe they have. I've seen them go higher. I see in Las Vegas mortgage rates are 7.5% to 8%. Okay, so maybe they've come down where you're at, but where I'm watching and what I look at, and when I look at the bond market, rates are not coming down, and I'm seeing a big slowing in construction because people can't afford to buy these houses. Remember, we got used to paying, 3%, 4%. Now all of a sudden, 8%. That's double the payment. It doesn't work out. The math doesn't work out. People don't have the money, and the sellers don't want to sell the house because all of a sudden they thought their house was worth $500,000. Well, with mortgage rates here, the house is worth $350,000 now.
That's a good point, because people aren't selling because of that reason, and so the price of homes has actually stayed high, if not gone up a little bit. Do you think that'll stay, or do you think that'll last? This price hike in homes?
I think the housing market's going to collapse. I think you're going to look at almost an identical replay to 2008. Okay, again, I'm not going to tell you when. I have no idea when this is going to happen. But it is my view that the stock market is going to be down 50 to 70%, and the housing market is going to collapse once again. In fact, I've already told my realtor Okay. That when the housing market collapsed, this is what I want to buy. I want to buy a number of properties because I can pay cash for them and I'm going to be ready to buy. But in my opinion, this market is going to collapse. This market is too well overheated, too well overbuilt. And just like all the empty shopping malls you see now, you're going to see a lot of empty housing developments as well because people cannot afford what has been done in this country.
What is a fair valuation of the homes that you're looking at? So you've told your realtor, wait. At what point are you going to go back in?
I want to buy a house for 50% of what it is today. Okay. My house, for example, the home I own in Las Vegas is $800,000. I want to buy the same house for $400,000.
You think it's overpriced by double right now?
Well, I don't know if it's overpriced. Again, it depends on what I can sell it for, right? I haven't tried to sell it, but I think housing is well overpriced, and it had a lot to do with the interest rates. And now, of course, in Las Vegas, a tax-free state, people are still coming here. In Illinois, this house would be trading at $350 because it's a tax state.
Turning back to the stock markets, I want to ask a trader this. So you've got the Russell 2000 that's kind of been flat all year, and then you've got the NASDAQ and the S&P 500 up on the year. Now, we know why. It's because of some of the tech stocks pushing up the entire index. But when you see a huge divergence between mid caps and the big blue chip companies, what do you do as a trader? Do you say, well, these companies are these big companies are overpriced and it's time to short, or it's time to go long on some of these mid cap stocks because they need to catch up?
Well, I think the mid caps and the small caps are being intentionally punished and actually trying to put out of business. I think that, you've seen a big move up in AI. I think we're seeing a lot of similarity to the 90s when you had the internet bubble initially. I think these stocks are overvalued. However, you can't just sell stocks because you think they're overvalued. Value is what the markets determine they are. And for today, they're still going higher. Now, again, I would think that they're overvalued, but I will give you one quick story. I had a choice. We were massively short in the 90s, and we had a choice either to take our losses and move on and not go broke, or hold and say that we were right. Well, as it turns out, we decided to stay in business and not go hold it. But if we would have held, of course, we would have made a fortune because we were right. But again, you have to make a decision as a trader and as an investor where your point is, where you can't take the pressure anymore. And I think you have to understand that I can't tell you that the markets are going to go down today. I don't know when. I can guarantee you there's a huge sell-off coming. I can't tell you when, and I'm not going to get extra short just because that's what I think.
Well, can you just walk us through your logic here? So if if one is not entirely sure when something's going to happen, of course, nobody does. So how does one come to the conclusion that the market's going to move either way, either up or down?
Certainly, I read charts all day long. Okay, they leave a footprint, they leave a map, so to speak. And when you start to see a market topping, usually starts with a big spike up at the end of a move, and then kind of goes sideways. You start to see a sequence of lower highs and lower lows. That's a pretty good indication that the trend is now turning over and it's going to go down. Okay, and if you look at Apple a couple of weeks ago when it was peaking, Apple did exactly that. It turned over and it became into a downtrend, which I am actually short Apple right now at the moment.
Are you short Apple for technical reasons or for the news?
Only for technical reasons. I don't. When I'm trading, David, it's only about technicals. I don't worry about fundamentals when I'm trading. When I'm investing and I want to hold something, then I'm worried about fundamentals. Okay, I'll still trade them technically, but I don't worry about fundamentals if I'm going to trade something for a week, 2 weeks, a month. That I can't really worry about. It doesn't really matter to me one way or the other.
So the SP 500 is currently at 44.85. If it retraces down to its August lows of 4,300, so a little bit down from here, what do you do then? Is it do you buy on the dip?
No, I'm short. I'm short the S&P right now, and I will continue to sell it until it gives me a reason to buy it. Now, if it gets down to those levels, those lows, and it shows me a bottom, just like in the top, if it goes down to a certain point and then starts to make higher lows, okay, and higher highs down there, then that would indicate that the trend is changing and I need to be a buyer or at least cover my shorts. But overall, I'm not going to worry about, there is no automatic buy or automatic sell. I have to have a reason based on a footprint that is being left by the market telling me what I need to be doing. And until that changes, I will stay long or short. Right now, I'm long the NASDAQ futures. I'm short all the others. Okay. And I will not change that until there's a reason to change.
Were you long earlier in the year? Did you make a switch at some point?
We were long, and then we got short for a little bit, and then we got long again, and then we got short the rest of the indexes. But yeah, I was long for a big part of the run up early because again, the trend changed early in the year, almost right after January, right during January when we had a big run up. And of course, the Nasdaq was up 47% at one point this year.
So what made you execute your most recent short position? So
again, it's all about the price action. When you start to see a market making lower highs and lower lows, you look for a reason to be short, and you find a level to short. You would sell an area of resistance. Okay, and when you see the opposite, you would be a buyer. And until that changes, there's no reason for me to change. And that's again, I'll sit with this. In I don't know, I think it's 2018. We were along the Nasdaq 47 weeks out of the 52.
Do you have a rule for holding a position in terms of time horizons? Do you give yourself a minimum number of days or a maximum number of days before you have to switch positions?
No, I will hold a trade as long as it's trending in a direction. I will stay with it until that trend changes. And listen, I hope it's 5 years, right? The longer it stays in that trend, the better off I'm going to be. Okay. The faster I have to change means that there's too much chop in the marketplace. And that's never good. That's always the hardest part to trade, which is part of congestion. It just depends on how wide of a method you're watching.
All right, so let's recap your trades right now. You're short the S&P. You're long oil. What are you doing with the precious metals right now?
Right now, I'm short silver. And full disclosure, I'm not a big fan, but I'm short silver on the board. But I do own a lot of physical silver. I'm long gold on the board. Okay, and I'm long gold in physical. Okay, I'm long platinum, in both spots. All right. And I do like the precious metals. I think that gold has a chance to make new highs still this year before it's over. I still think silver, although I'm short right now, I still think silver has a chance to hit $30 this year. But again, it's obviously problematic here, but I am short, so it's okay. And oil, I'm long, I'm short the S&P, I'm short the Dow, I'm short the Russell, long the Nasdaq, short the grain markets, which doesn't make me happy. But they're lower. So what do I care? I want to make money. There's an old saying, amateur traders want to be right. Professionals want to make money.
Well, I want to finish off on your trading strategy in just a bit. But okay, going back to your gold call, why would gold go to new all-time highs if you're also expecting the 10-year to continuously moving up? I mean, wouldn't yields put pressure on gold?
Well, again, we have to understand that correlations don't always happen. The last time notes were at higher interest rates, gold was also higher. The correlations sometimes play out in different stages. So I can't worry about that. Gold has been relatively under pressure pretty much the year. I mean, it made one nice pop, got over 2,000, and since then it's been sideways to lower. I think that's already accounted for rates that are higher than they are now. And I think once that all resolves itself, I think there'll be some new money that will come in and start buying gold.
Wait, what did gold react to earlier in the year? You're right. It had a big pop in March, and then it traded sideways and down. What was that?
And interest rates were popping at the same time higher.
Right, exactly.
Again, it happens all the time. Again, too many people look at a short-term correlation like it's going to happen today at this minute, and that's not necessarily the case, right? Everybody worries about the higher dollar and gold, for example. Well, gold is still at 1940 or whatever. What is it right now? It's 1934 right this minute, and the dollar is at highs it hasn't seen for months. Okay, and gold is holding up pretty well if you think about it. When you think about how high the dollar is compared, and that's why I tell you that correlations are something that you better not use as a trading strategy, or you're going to lose everything.
But early in the year when gold had a big pop, was that reacting to the banking crisis or something else?
No, I think it was reacting to new money coming. And again, I think we put too much emphasis on news items that are already priced into the market. You see, today's with all the information, there's not that many surprises anymore. Okay, tomorrow's number is not going to be a major surprise. The surprise in tomorrow's number is if it's bullish when the markets go down after a bullish report, because they've already priced in the bullish report. The markets are much more efficient, and every year they get more efficient because information flows so much faster. When I first started trading, we had a 12-inch LED screen for 50 traders to look at. Okay, now everybody's got a more powerful computer in their pocket on their iPhone.
You ever traded the floor? I'm just curious. You ever go to
I traded the floor for 35 years.
Oh, you did? Okay. They had a big LED screen back then, just one? Was
Well, in
it,
the office, we had one. Obviously, we had screens and boards on the
right,
that we were in the
right.
pit. Okay, but in the office, there was one screen for 50 guys to look at. Okay, and it did. It wasn't. It was a DOS based. It wasn't Windows based. The world has come a long way. We used to actually really stand in front of the screen, 50 guys looking for the money supply to come out on a Thursday afternoon, right? Or a jobs number to show up. Now you already know that information. I can get it on my phone in 5 seconds.
You've got a book now called, let me just pull up this title here, Bubba's Guide to Trading Options. So, first of all, I didn't know you write books. When did you author this book?
I wrote this book about 10 years ago, and then I wrote a follow-up to it, Bubba's Guide to Weekly Options, and the Bubba's Guide to Trading Options was on Amazon. It's still on Amazon, but it's sold out. But I do have PDF copies that I'd love to give to any of your listeners and watchers who would like it, and they can email me at bubba@bubbatrading.com, and I'll give them a copy as my gift because I love being on your show.
Well, thank you very much. We'll put the link to the book in the description down below, so make sure to check it out. Bubba, give us a summary of, well, I don't know if you can give us a summary. I'm sure there's many strategies covered in this book, but first of all, why did you write this book? What 10 years ago, what inspired you to, sit down and write this book?
Well, I came off the trading floor because there really was no more trading floor at that time, even though it existed for a few more years. And I've been very fortunate in my life. I've always traded my own account for my own money. And I felt that I could pass on education to others who struggled in these markets and struggled with their investing and in their trading. So I thought I could teach a better way. And what better way than to communicate with people than to put it in writing and have them be able to read it and reference it and actually even email me if they have questions about it.
Okay. I know a guy who mortgaged his house, took that money, and only traded options. He only sold naked calls or naked puts. And apparently, according to his very complex strategy that he didn't disclose, he was hedged somewhat. Can you just evaluate what I just said?
He's an idiot. Okay. He's a guy that's going to, if he's not broke yet, he will be broke, because anytime you're putting yourself at that kind of risk, I've watched funds that make money, and then they all end up broke. And I will reference optionsellers.com, who everybody wanted me to get involved with. And I told everybody, if you do, you're nuts. And they're all broke. And 5 years later, they're still paying off the debt that was created from that strategy.
Options is a very difficult thing to trade. You've got to be in front of the computer 24/7.
No, you don't. Options are actually really simple, especially if you use the strategies that are taught in the book or strategies that I teach, because we don't take unlimited risk. We know our exact risk on any given trade at any given time. Okay, I don't have to look at all. In fact, half the time I'm on the golf course, I don't watch these positions. I don't need to look at them every minute. I know what they're doing. I know what to do. It's very simple. Options. If you don't get yourself involved with garbage and you learn to understand the different strategies that you can use and how you can always protect yourself, then there's no big deal. There's no problem.
Are you mainly a seller of options or a buyer or both?
Both. And typically, a normal strategy for me is to buy options out. Right now, I'm buying options in October, and I'm selling in the S&P, and in the Qs, I'm selling daily options. Okay, but in the others, I'm selling weeklies.
Do you use options? Do you use options to hedge your underlying positions and
that's another strategy. But yes, my entire portfolio is hedged to a maximum risk of about 3%. So no matter what happens, and I'm always buying more stock, and the system that I do actually buys more stock automatically when it's supposed to.
So just to recap, overall, would your option strategies be a risk-reducing measure, or are they used to amplify risk? And I mean amplify risk by, let's say you got a long position in Apple, okay, and you're saying, well, that's not going to move, enough for me. Let's buy some call options. That's amplifying risk.
My trading strategy is to use leverage and not necessarily increase risk, but increase power of if the stock does what I think it's going to do. My hedging strategy is risk averse, which will protect me and allow me to stay in the market through very adverse conditions. So if my stock's going down 25%, I'm only losing 3 or 4%. So I can live with that, and I can actually buy some more stock on the way down. Versus if I'm trading and I want to use up leverage, I'm going to get more aggressive. But no matter which strategy I'm going to use, there is a limit to the amount of risk I can take by the way the trade is set up from the beginning.
Okay. All right, let's read this book. I want to read it myself now, so I can learn more and ask you next time about specific strategies. But that was a good introduction. Yeah, let's put the link down in the description, and we'll follow Bubba's work. Bubba's Guide to Trading Options is the name of the book. Where else can we learn about you and your work?
BubbaTrading.com. You can go to my website, and you can listen to my interviews, and you can also, I do a live Monday call every Monday night talking about markets for about an hour, and you can certainly come and as my guest. All you do is shoot me an email. I'll send you a link, and you're welcome to come and join me.
Excellent. We'll put those links down in the description below as well. Thank you, Bubba, for your time and your wisdom as always. Looking forward to next time.
David, you're awesome. I appreciate it. Thanks, man.
Thank you. And thank you for watching. Don't forget to like this video and subscribe.